In the second quarter of this year, the 90-day incident delinquency rate on credit cards, that is, the number of consumers who owe at least the current payment and 3 past due payments, dropped to 0.92%. This is down a little bit over 17% from the first quarter of the year and more than 21% down from the second quarter of last year. On the balance side, credit card balances on average dropped to about $4,950 per borrower. This is the first time since the first quarter of 2002 that this balance has dropped below $5,000. Both of these indicate that consumers are working really hard to maintain the health of their credit card relationships. It's important to note that in the second quarter of 2010, credit card balances dropped on average for the average borrower for the 5th consecutive quarter, despite the fact that the economy continues to be somewhat tough for many consumers. This is a sign that consumers are really working hard to maintain good relationships with their credit card lenders and also to maintain an economic cushion, a financial cushion, in the event of uncertain times or tough economic conditions. They want something to be able to rely upon if they lose their jobs or if they have unforeseen expenses that they need to cover. This is in fact seen also in later stage delinquency. So for consumers that owe not just the current payment and perhaps one additional past due payment, but for those that might owe 3 or 4 past due payments in addition to the current payment. Those rates, the 120-day delinquency rate, has had the biggest decrease into the second quarter since the recession began at the end of 2007. This is continuing good news to show that consumers really are working hard to maintain the health of those relationships. Since the beginning of the recession, TransUnion has put together both national and state level forecasts to figure out where credit card delinquency will be going over the near term. These models are based on a lot of economic factors, such as median home value, unemployment rates, savings rates, and so forth. These models have actually been tracking very well against the actual results that we see quarter over quarter, and in fact, in the second quarter, we were within 2% of the actual delinquency rate. Our models continue to hold up well, and we forecast that credit card delinquency through the end of the year will stay below 1%, tracking where approximately we are now.